Hello, Namaskar. Welcome you to the SAAR Analysis. I am Chavan Naik and here's my take. What if I told you that India's banking system is reporting its healthiest balance sheet in more than a decade? And yet, the country's central bank is still preparing for a possible rise in the bad ones. That sounds contradictory. But the numbers are real. Well, India's gross non-performing asset has fallen to just 1.8 percentage, the lowest level in nearly 2 decades. Yet, the Reserve Bank of India's latest financial stability report warns that under the stress global scenario, bad loans could be more than double to 4.1 percentage by 2028. Well, this isn't just a banking story, it is a warning about how geopolitics can reshape the financial stability report. Let's dig it out. Now, here's what evidence speaks about. India's bank have spent years cleaning up their balance sheet after corporate debt crisis for the latest decade. When the capital buffers are stronger, profitability has improved, this provisions remains healthy. Public and the private sectors are entering this period from a position of relative strength. But the RBI's stress test don't measures about today's economy, they measures about tomorrow's risk. Well, its adverse scenario assumes a world where geopolitical conflicts intensify, energy prices remains elevated, inflation stays persistent, and currency become volatile. Well, under those conditions, now borrowers struggle, business delay, and the household find repayment harder, and banks are inevitable to face rising defaults. Well, now the question arises, why is this important? Because this matters far beyond India. Well, India is now the fastest growing major economies and critical destination for the global capital, international investors, sovereign funds, multinational cooperation, and it increasingly depends on India's financial system to remain stable. If this geopolitical conflict continue to disrupt the oil markets, trade routes, and investment flows, the pressure won't remain confined to Europe or Middle East. It will eventually reach the balance sheet in emerging markets, including India. Well, the RBI's message is therefore not pessimistic, it is preventive. Well, the strong banks today do not guarantee strong banks tomorrow, and the financial resilience depend not only on the domestic reforms but also on the international market, energy security, geopolitical stability, and most importantly, inflation dynamics. This is precisely why central bank conduct this stress, not because they expect a crisis but because they are preparing for the tomorrow's market. Well, here's my take. The most important headlines are not that India's bad loan may rise. The real headline is that India's financial regulators are planning for a geopolitical shock before they become financial shocks. Well, in this increasingly fragmented world, the strength of a nation's banking system will depend as much as events in the Strait of Hormuz, Eastern Europe, or the global market, and that's the new reality of the global finance. Well, that's all from today's analysis. I will be back with another episode. Till then, thank you for watching this.